Thank you for staying tuned. By 2 p.m. today, the Central Bank Governor, Mr. Godwin Emefiele, will be announcing the decisions of the Monetary Policy Committee on the next monetary policy direction. And you would recall that the MPC surprised the market with its first rate cuts in more than 3 years in March in a bid to boost economic growth. And as the MPC meeting continues today, what are the major considerations and what is the outlook? I'm being joined by an economist and the chief consultant at B. Adedipe Associates, Dr. Biodo Adedipe. Thank you very much for joining us, Dr. Adedipe.
My pleasure. Thanks for having me.
Sure, good to have you in the studio. Well, the MPC is concluding its meeting today, and there are basic considerations before they can arrive at a conclusion. They will look at the global factor and, of course, the domestic factor. Now, let's begin with some of the developments in the global economy,
Right.
the high oil prices, trade tension, and of course, we have the geopolitical risks coming up now with Trump and Iran threatening war. Now, how would all of these shape the possible decision of the MPC today?
Well, by all means, all of these are important considerations in the decision of the MPC because we play within a global market where we do a lot of trade, quite all right. We sell and also we buy. And that means there are major variables that we have to look out for. And of course, also map the risks that are within such environment. You've mentioned the key considerations there. One is oil, which is very fundamental to Nigeria in terms of our external sector. It means what is happening to the price of crude oil in the international market. Happily for Nigeria, it is positive for now. And in my own, take of it, I see it remaining positive in the near term. And obviously because once the geopolitical environment is unsettled internationally, it has a way of positively impacting the price of crude oil for sellers like us anyway. Of course, for the consumers, it's bad news because it makes oil more expensive for them. But also it comes back to Nigeria as well, because for now, we import most of the refined products that we consume. And that means we gain on one side in terms of the high price. We also lose on the other side in terms of the cost of refined products. That is as far as oil is concerned. The other side now is talking about international trade itself. Okay, so the big question for us is the interplay between the oil and non-oil sectors. Okay, the bulk of our exports still remains crude oil, condensate, and associated gas. So to that extent, it means that the impact on our foreign earnings will still likely be positive. And that, of course, will feed back into central bank's decision in terms of what to do with the management of the exchange value of the naira. Which means then if we don't expect anything adverse, the chances are that we have an accretion to reserves. If there is continued accretion to reserve, then there won't be any worry in terms of the exchange value of the naira. So I don't expect central bank to be worried in that respect. Then, of course, inflation is another issue because there are two sides to it as well. There's international inflation, which relates to the imports. We import a whole lot of non-oil goods and, in fact, even services. Okay? So if inflation is moderating globally, but that's the pattern globally. But for some countries, as we speak now, they are worried as to the direction of inflation rate. So it's going down, and the concern also is that, hey, they might get into deflation at some point, which is more difficult to deal with than inflation as an economic problem. So given that international environment with inflation, the likelihood is that coming back home, we've had a measure of stability over the last 14, 15 months, more or less. So we can then say that, yes, central bank would not be worried so much about inflation now, despite the uptick in April. And it is also very clear when you talk about growth. If you want growth, you can't escape inflation. Let me leave it there for now so we can take other issues.
It's okay. Well, let's look inward, still talking about those considerations in the economic outlook. Now, the economic outlook in Nigeria, do you see it optimistic or pessimistic, given the key economic indicators? Yeah, you talked about inflation. Yeah. We have the PMI.
That's right.
We have the exchange rate,
that's right,
which, of course, is currently at 361 in the parallel market. I keep using the parallel market rate because that's the market most of us have access to. Yeah, then the crude oil price, foreign reserve, currently at 45 billion, and then unemployment, we just saw the GDP growth.
That's right. Now, for me, I'm optimistic for the economy this year. In fact, right from the beginning of the year, my expectation of GDP growth rate this year had been between 2.65% and 2.7%. And that still remains my expectation, and it is quite obvious. Now, if you look at what we have done with respect to the growth sectors and also what I call the growth drivers, we've been pulling in the right direction. Growth sectors, of course, we come from two perspectives. One, those sectors that account for the bulk of our GDP, and there are 6 of them. That has not changed, even with the last GDP data that came out only yesterday. Agriculture, manufacturing, real estate, trade, ICT, and of course we have as well there is one more sector, mining and quarrying. Okay, even though mining and quarrying now is quite soft in terms of what happened in the oil sector. Now, if you take all of those, they accounted for about 76.5% of our GDP first quarter of this year. So the big numbers there in terms of sectors still remain. They haven't changed. Now look at the growth of those sectors. Now, when we talk about growth sectors, we also look at those that are growing fast. And that is where we need to do more work. Now, you look at the sectors, 19 of them on the GDP table. Now, in the first quarter of this year, 9 of them experienced positive growth. 9 of them slumped. 1 was flat, 0% in terms of growth. Which means if you look at the 9 sectors that grew, how do they relate to those big numbers, the sector that account for the big numbers? You find a mix again there, 3 by 3. Okay? So that tells you that, yes, the prospects are still fairly positive. But what are the growth drivers? Energy, infrastructure, and then you talk about education and health. And those are the areas where government needs now to give attention to. So question coming back now to MPC, what should they be looking at there? So it means then that if all the macroeconomic statistics are positive as they are right now, they should be looking at specifics that can impact job creation without the ultimate end. If you create jobs, you deal with poverty. And of course, you can also create jobs if you are not growing the economy in the sector that are important.
No, Dr. Adelupe, what specifics now do you think the monetary policy should be looking at? Because to grow the economy, it's not just about the monetary policy.
Correct.
The fiscal authority also has their own duties there to play. The monetary policy can't really do it alone. So with the MPC meeting, how much can they really do?
Well, if you look at the monetary policy side, there are 3 major variables that the Monetary Policy Committee always look at and be concerned with. And those are, 1, the cost of money, which talks to interest rates, and also the flip side of it, price of money if you have to borrow. Okay? Then, of course, the volume of money in circulation, and then credit itself, that is supply of loanable funds. Now, these are the ones that will be primary to them. So that is why the MPR will be an issue for them. But in my own expectation, I don't think there will be a change in the MPR. Noting that only 2 months ago, there was a drop in the right direction. But that's what we always advise here, that the rate is a signal rate. And what is being a signal is that growth is now important to the monetary policy authorities, which is good. But I don't expect that to change, because they want to see the effect of that maybe at least over 6 months. That's on the one side. Now, the other side to it is, how do we make credit accessible? And then make it also affordable. So that talks to interest rates. So they will have to also embark on moral suasion more with the banks to see how lending rates by the banks can also come down in line with the direction set by MPR. Okay? Then, of course, the exchange value of the naira, there's no worry there. Because you have external reserves that can pay almost 20 months of your import bills. And that is quite comforting in a way. But if your economy is growing, most likely you'll also be importing more. In which case, your import bill per month will also grow. And that means the number of months you can pay for with your external reserves will also drop. But apart from that, other commitments as well. So I don't see them having any worry about the exchange value of the naira. So that brings us now to the pragmatic direction of monetary policy. Now, generally and globally, in the last 11 years, the direction of monetary policy has been pragmatic rather than the traditional and historical rule-based approach to monetary policy. It is now about principles. And that is where the connection between monetary and fiscal policy comes in this instance. Where fiscal policy is not strong enough or lacks the muscle to push the economy in the direction required, monetary policy now has to step in. Which case, you no longer look at the fact of monetary policy as a mission, which is restricted to those three elements I mentioned, but now you are looking at development as the key issue. So how do we get development? It means monetary authority must go beyond the traditional monetary instruments and tools, and even what you call medium-term targets and the rest of them. So even going beyond inflation targeting, all right? So it then means the critical issue is grow the economy, create jobs. And that means central bank must continue to intervene in those sectors that I mentioned earlier on, the growth sectors of the economy.
Okay, now, you are sounding quite optimistic, and I'm very happy about that. However, there are a lot of people, particularly since the release of this GDP number yesterday, that are quite pessimistic about the growth of this economy. Some of them are talking about, oh, Nigeria might likely get into recession. Do you fear any of this might happen? It's even in the papers today.
That's a misinterpretation of data. Now, and I say that with every sense of responsibility and respect for such analysts. Now, if you look at the Nigerian economy historically and the pattern, beginning of the year, first quarter, the economy slows. Second quarter, it revs up in terms of speed. Third quarter is when you get the highest growth rate traditionally. We probably will also do well in the fourth quarter. If you look at the data historically, and I'm talking of about data of 40 to 50 years now that is available. Now, if you look at that, usually first quarter is the slowest growth rate in the year. Because oftentimes people wait for government policies, either as a budget, fiscal policy, tariff structure, and all of such issues. So they wait until they get that and see how that affects their business. The second quarter is when real business usually starts in Nigeria. So I expect Q2 GDP growth rate to be faster than Q1, okay? And then, of course, Q3 usually is also faster than Q2. So the usual worry is Q4. And that is when you need to do a whole lot of work in terms of intervention. Because usually, toward the end of November, December, there's a slowdown, year-end activities. People want it to wrap up. But again, for an economy that is desperate for growth, I don't see that happening this year. So given that historical pattern and what the data is saying also, not the data at this point, but historically, what I see is recession is quite far from Nigeria. Okay.
All right, now let's look at the currency market. You keep mentioning it, the foreign reserves, the CBN continuous intervention. Right. Now, there's also this concern and worry from some quarters that this intervention by the CBN is actually not sustainable, and it seems to be playing out just as we saw the Naira close at 361 at the parallel markets yesterday.
Okay, now the word intervention itself simply means it is not something that is going to last forever. Intervention is momentary, and all you want is to gain a momentum that allows that market to drive itself. Okay, as it were, the reality is that the bulk of your foreign earnings is from oil, okay? And how does that money go? It goes to CBN. CBN now converts that into Naira and releases to the FAC account, all right? So that means, in essence, that in reality, the bulk of the FX that comes into Nigeria ends up in CBN. So CBN now means the one having the power to intervene in that market. And I also find it very strange the way we interpret things here. Now, if you look at central banking as an aspect of the banking profession, banking there says that the central bank will always intervene in the FX market on either side, depending on where the rate is and where it wants rates to go. So it means intervention is not only about CBN selling. There could be occasion for it to buy when the market strengthens. But for now, to the extent that it receives the bulk of our earnings, and it is the one that converts that into Naira, it has the dollar account from which it can intervene in the market as required. Intervention is the normal job of the central bank. That's the FX market. Now, the one we can put a question mark on and say for how long will be the real sector intervention. And that's why I said that will be for the moment until those sectors develop the muscle to run on their own without CBN intervention. And then the other side to it is for the banks to also come in there and play their own role. Once the banks play their role there will be no need for CBN to intervene in the real sector.
All right, Dr. Adedipe, just a quick one before I let you go. Now, whatever decision they come up with, what are the risks to price stability, financial stability, and of course, economic growth in the near to medium term?
Well, if MPR comes out retained at 13.5, I don't see that as a risk, either in terms of the financial market or in terms of even the real sector, because it is something that some of us have argued for over the last 3 years, in fact. So doing it for people like us is a step in the right direction. So if they still want to watch how that plays out, I don't see any risk in that. Okay? Now, for the FX market, I don't see any risk there as well, because in the last almost 18 months now, we've had relative stability in that market. And that is looking at the importer, investor window. Exporter investor window. Now, if you look at what is happening there, the rate has been fairly stable. In fact, we've seen a move more by the parallel market to now, let me say, merge in terms of the rate. So the margin there, what we call the premium, is very, very thin. And so, to my understanding, that is a positive for Nigeria. So the risk there is also very low. And so it means then that if we don't expect devaluation of the Naira, and I don't expect that for any reason, because all the reasons that we can use to justify that, they don't hold in Nigeria at the present moment. In which case, the risk that will imply is also not there as at now.
All right. Thank you very much for your time, Dr. Adedipe.
My pleasure. Thank you.